This is Money Made Simple, the financial podcast that keeps it simple and gets to the point.
Welcome back to Money Made Simple, brought to you by Simplicity. Today, I am very excited to be again joined by Shamubeel Eaqub, this time as part of Simplicity. So welcome, Shamubeel.
Thank you.
So Shamubeel, just for those who don't know already, has joined Simplicity as our chief economist and our head of policy. So advocacy, a really big thing, and then also giving a whole lot more insights as to what's going on in the economy. On that note, today's topic is one that is a really big thing at the moment. It feels like there's lots of headlines around it. Lots of people are talking about it, and that is inflation. First of all, just because I think this is a term that's talked about a lot, but not necessarily understood really, really well. So let's just start with the basics and actually break down what inflation means.
The way that we talk about inflation is what's happening to your cost of living. Is it increasing fast or is it increasing slowly? So what happened was, in the post-pandemic era, just after the lockdowns, we had very big increases in prices of food, fuel, rents, things like that. And that was really because there was all this disruption in the economy. And for individuals and for families, that meant that when you went to the supermarket or when you filled up your car or whether you paid paying your rent, these things became more expensive. So if you look back over the course of the last 30 years, the cost of living goes up by around 2% a year. Last few years, they were rising by 6%, 7%. It became quite a big shift.
So when it's 2%, you don't necessarily notice it, right? Like your wages go up as the cost of goods goes up. But when it gets up to that 6, 7%, that's when it starts to hurt, right?
Absolutely. I think when it's predictable, when we know that it's going to be increasing just a little bit, used to it, right? But when it increases really sharply, you don't have time to change or get used to it, or your wages don't keep up with the increase in the cost of living. And so that's what I think really hurts. It's not just the increase in prices, but it's the effect that it has on you and your budget. You need shelter, you need food, you need power, all those kinds of things. So you can't avoid those costs. If they're increasing really fast, it means all the other things, particularly the fun things in your life, quite often get squeezed out because you just don't have enough money left over at the end of the week.
So what are some examples potentially of some goods that would probably be, and especially in this inflationary time like now, some goods that would be really startling different from what they used to be?
One example is chocolate. I was looking at the numbers. So before the pandemic, it was $4.50 for a block of chocolate.
Right.
On average.
Yes.
And now it's $5.30.
Okay.
So it doesn't feel like a lot, but, almost $1 more expensive for a thing that's not that expensive. It's quite a big increase. Or the price of steak used to be under $30 a kilo for a sirloin in 2019. It's now over $35. So
that maybe just because it's more dollars seems a bit more of a difference.
It's quite a lot, right? So if you want to have steaks on the barbie, all of a sudden it becomes quite a big outlay. So we've seen this happen in lots of different things and for lots of different reasons. So food prices have gone up a lot because we had lots of disruption during COVID. We had the war in Ukraine, and they had this kind of weird effect because that part of Europe is very big in terms of producing lots of food, particularly grains. We had things that happened locally, right? We had the floods in Auckland, we had the cyclone in the East Coast that really drove up the price of vegetables because a lot of the crop was affected. And for most New Zealanders over the course of the last 3 years, I'd say, it's just gotten dearer and it's just not getting easier.
No, we don't really talk about the reasons, right? We just talk about the fact that it's ridiculous that it's gone up 70% year on year, 1 year.
This is it. And I think sometimes I think it helps to understand why it's happening, but it still doesn't change what you do with it, right? When you go to the shop, it's still expensive.
Yeah. But what about the current headlines? So where it feels very celebratory in the headlines around inflation is back at 2.2%, I think the latest figures were. So that means that the OCR can come down and mortgage rates can see a bit of easing, but it doesn't really feel like that's helping, right?
Sure. And I think it's this weird thing, right? And what we're talking about is the rate of inflation has slowed. It doesn't mean prices have fallen.
Or deflated.
Yeah. So what we've seen is prices went from here to up here, and they've gone up a little bit more, but not as much as in recent years. So it's not increasing as fast.
So we haven't got relief from that 7%, really. It's just stopped growing so fast.
That's it. And so what we have experienced is over the last 3 years, lots of things have gone up in cost. They've kind of remained at a high level, but they're not rising as fast. So I think we're grateful that it's not getting more expensive.
But not that grateful.
But not that grateful because it's not getting cheaper, right?
Yeah.
And so I think what we're seeing from New Zealanders, so surveys like Ipsos shows that the biggest concern for people still is inflation. Even though the rate of inflation is slow, under control, all that kind of stuff, for most people, it kind of feels like things are still really expensive. Because it is.
We're still doing it tough, right?
Well, we are still doing it tough. And it shows up in slightly different ways for different people. So for a lot of people, they have sufficient disposable income that they'll absorb the increase in the costs. But for other people who are on more limited incomes, it means they're having to cut back. And so when I was talking to some of my friends who are in the fruit business, they said they've seen people trading down from Watties or not going out and instead cooking a fancy meal at home. So people can make choices and people are cutting back on different things. At the more extreme end, what we're seeing is people are going with the basics. So last year, something like 40% of New Zealanders didn't buy fruit or vegetables regularly.
And that's the worrying bit, right?
That is really worrying because when you put this big increase in the cost of living, it can have a really devastating effect on those people who are doing it really tough. It can feel like they're under a lot of pressure and it can create a really toxic environment.
And as we all know, stress is just such an awful thing for our health, both physically and mentally. And so, I mean, inflation and, the impact on cost of living and then the impact on our mental health, kind of like a downward spiral, right?
It can be if you don't deal with it. I mean, if you don't get help, if you don't get support, it can become a big issue. And the way I think about it is being under stress is hard because it's hard for you to kind of find the time to think about things, to get relief. And, people tend to use their red brain,
Emotional brain, yeah.
the emotional brain rather than the rational brain. And when you're making big decisions, it's really hard to be rational or be thoughtful in what you're doing.
Because there's such a high level of anxiety out there, high levels of anger out in the community, but it's not really a healthy place to be. Even though it's for good reasons, it's really difficult for us to be in that state of mind for a long period of time.
So it's a tough one. And in terms of the recent inflation, because I know you economists are celebrating that it is starting to get back under control.
Yeah.
We talked about a couple of the drivers, but I just wanted to touch on this whole global or imported versus domestic inflation. Can you kind of explain the difference and what of those have been the biggest drivers for the recent high inflation times?
Yeah, really good question. And I think that's been the reason why inflation has been so unpredictably high. So right at the beginning, when the pandemic happened, it was very global in nature. It was those big shocks. Ports were not working, factories had closed down, and then we had the war, and there was very much about food, very much that imported thing. But in those first couple of years of the pandemic, we also had lots of support through government support for businesses and households, big reductions in interest rates. So people really went out and borrowed and spent. And that meant the economy was growing really fast. But we didn't have enough workers. When you have so much demand, the businesses can't keep up. They raise prices to say, well, too much.
It's that classic demand supplied.
So we went through this pandemic, then we had the war, then we had this domestic inflation shock. The economy was too strong. So we've been through this kind of 3 years of quite high inflation around the world, but it's now starting to come down and it's moderating and it's likely to stay that way.
So when the economy slows, we tend to see domestic inflation come back. The global inflation is a bit more to do with what's happening out there.
And how about things like the floods or the cyclone? That's kind of more domestic?
Very much so. So when we had the floods and the cyclones in New Zealand, we had quite short-lived shocks to prices. But there's one cost that is sticking around, and that's the cost of insurance.
Yes.
I think most people who have noticed how much that has gone up over the course of the last couple of years, and it's very much related to the insurance losses that we have seen in New Zealand, but also globally, because the insurance markets are quite global in their nature. And so with the floods and the cyclones, we've seen an increase, and also because of storms and floods and fires around the world, unfortunately, related to climate change. Mm-hmm. As a result, what we're seeing is some people are not getting full insurance. They're reducing the cover. There's quite a lot of risk with that because quite often it's all your belongings or your biggest investment.
So on that note, let's talk about our own finances and what we can do in an inflationary time. And I know that obviously inflation has come back down, but we're all still feeling it, right? That's
Absolutely.
Kind of the guts of this. So how might Kiwis consider kind of looking at ways to factor in or budget for inflation?
The thing with inflation is it's a little bit outside your control because it's happening up there and you kind of have to make it fit you, right? And so that starts with, I think, really understanding your own finances, having a reasonable budget, reasonable idea of what you spend your money on, how you're spending it, and why you're spending it. And that really helps, right? Like with the example of insurance, it might be a really good catalyst for you to go out there and look to see, is there some other provider or some other way of getting insurance that might still give you good cover but at a more affordable price.
I think that actually goes across other things as well. So I just recently realized with my current mobile phone provider, I pay $80 a month. And I know, right? And I just haven't thought about it for years. And that's my bad. But I've just been, do you know what? I actually think I saw an advertisement and I thought, hang on, like, do I need to be paying that? And I've realized that I can get exactly the same deal or coverage that I have for about $40 a month.
This is it. I was going to say, I spend $40 a month and I'm very happy with my plan. Sometimes these shocks can be quite useful to relook at things because it's very easy to get stuck, right? Whether it's your power bill or whether it's insurance, those things are big purchases. And quite often they're out of money because they're direct debits and the money just goes up, right? So having a really good look at your finances helps. But if you're still struggling, there's always things you can do on your weekly budgets. People do it, I think, intuitively, like trading down, moving to other things that are still nutritious for food, but cost less. Making those little changes can make a big difference. But that's not going to be right for everybody, and some people will need some help. So financial mentors are really, really excellent. So I've done work with them in the past, and the thing that I find with them is they really listen to understand what you want out of money. And that's good because these are experienced people who can help you if you don't have the tools or the skills to do it yourself. And there's also things like money talks. You can call them up, you send them a text, whatever.
Well, how about your investments? So we just recorded recently a podcast on the generational differences and how they deal with their finances. And some of the older generation like cash in the bank, right?
Yeah, the cash in the bank is always a little bit of a danger because the returns are quite modest. It's very safe for a reason, right? And so it's safe, but the returns are always going to be quite low. So by the time you take away taxes and inflation, it's not doing a lot. And that's why you need to have diversified savings. So when you invest, you need to have a broad coverage. And by and large, during inflationary periods, because prices are rising, business profits also tend to rise. And hence, you tend to be a little bit more protected when you've got investments that are also in equities and in a good balance. So the way that I think about financial markets, particularly equities and investments, is that there will be ups and downs. But history shows that on average, over time, they give you good returns. So if it's for your retirement, hopefully you've got some time to recover from market ups and downs. If you can stick it out and continue to contribute regularly, you'll be better off being in the market and focusing on your contributions rather than focusing too much on just exactly what your money is doing at any given day.
So despite inflation, despite that disposable income feeling like it's being squeezed, if you can have that discipline to keep putting a little bit away, that's going to make the big difference in your future.
Absolutely. Look, but it should not be at the cost of your dignity or your quality of life. I think it's really important not to do that, right? I think, and I can't believe I'm saying this, but savings can't be at the expense of you living your life today. When times are tough, that's what you should be using savings for.
Right.
And either to use your savings or to reduce your savings rate so that you just have a bit of a buffer. Because things will get better. And I know when we talk about things like inflation and what's been happening, it feels a little bit dark because it has been tough. But when I look forward to the next couple of years, I feel really optimistic because I can see that the economy is stabilizing, and that means that over the next 12 months, we should start to see more jobs coming through, wages starting to increase, and it's unlikely we're going to have the same kind of increases in prices. So this purchasing power that we have lost in the last few years, we're going to slowly pull that back. So things will feel better. And so it's really about navigating the next 6 months or so when I think things will still feel a little bit tough because we're still feeling the after effects of those big increases in prices in recent days.
And just finally, because I know that a big part of your role with Simplicity is around advocacy, how about the government's role in all of this, in terms of driving both inflation and trying to claw it back? Obviously, the Reserve Bank of New Zealand has a big part to play.
The saying hindsight is perfect. It's a little bit like that. So I won't accuse them of getting it wrong because during the time of the pandemic, we had no certainty. And the no regret strategy was to be as bold and as big as possible in terms of support. And I think that was the right thing to do. But what happened as a result was we overcooked the economy a bit and we overcooked the inflation, and we're kind of paying the price of that now. When we look forward in terms of what needs to happen, so there are two big levers that we can play with: interest rates going up and interest rates going down. So when inflation is high, the Reserve Bank will raise interest rates to control the economy, pull it down, reduce inflation. And once the economy slows and inflation is under control, they need to cut interest rates. So we don't start losing our jobs and the businesses closed. So it's very much trying to find the Goldilocks balance, but it's really hard. We had an economy that was too strong, and now we have an economy too weak. Unfortunately, I think it's through the journey is people at the margins who get hit pretty hard. So that feelings of stress, that feeling of not having enough money, that feeling that I'm not confident enough to make the next career move just in case the market's weak and I lose my job. All those kinds of things really weigh on people, right? And so recessions are quite painful periods, and inflation and recession together is particularly toxic, right? Not only are you dealing with the cost of living crisis, you're also dealing with this kind of uncertainty if you're going to have a job, or if you're going to get a pay rise, or if your business is going to fail. So those things are, lots of worries all in one go.
I think that inflation and recessions are correlated really strongly, or one's caused by the other.
It tends to go together. So when the economy is really strong, we tend to have high prices, higher inflation. When the economy is really weak, we tend to see lower inflation. But this time around, what happened was because of some of those external events and pressures, we kind of had inflation that was really high for a long time. But the economy started to slow much earlier. So we've weathered both the pain of inflation and the slowing economy at the same time. And it's a first for many of us.
It's been a shitty year.
It's been a very tough year. And it's not just 1 year, right? It's on the top of all the destruction of COVID and, within the confines of the lockdowns and closed borders, and then kind of dealing with whatever is happening now. So it's been a very uneven and, I think, challenging environment for a lot of people.
You can say it more eloquently than me. I just call it shitty. But it sounds like the future will get better. As you said, people can, and we really encourage people to ask for help. And interestingly, to use those savings if you really need them, right?
Absolutely. It's okay to ask for help because you're not alone. Everything that we can see out there is lots of people are struggling with this stuff. And sometimes a problem shared is a problem halved.
Absolutely. Fully believe in that. All right. I think that we will wrap it up there. So thank you so much, Shamubeel, for your second podcast. And obviously for more widely for being part of Simplicity. So I'm sure we'll have lots more opportunities to chat in the future, and very much look forward to it.
Looking forward to it.
We'll catch our listeners next time. Thanks.
This podcast contains personal opinions and is intended to provide educational information only. It doesn't relate to your particular financial situation or goals and is not financial advice or recommendations. Simplicity New Zealand Limited is the issuer of the Simplicity KiwiSaver scheme and investment funds. For product disclosure statements, please visit Simplicity's website, simplicity.kiwi.